Imagine you're traveling abroad. You exchange $100 for euros. You get 90 euros. You think, wait, why not 100 euros? Or maybe you check the Japanese yen and $1 buys 140 yen. Why does $1 suddenly become more in one country and less in another? Why do currencies fluctuate? Why can the US dollar buy more than the Mexican peso, but less than the Swiss franc? Currencies are more than just paper and coins. They are power, trust, and economic history condensed into numbers. They shape trade, inflation, wealth, and even geopolitical influence. And yet, most people treat them like magic numbers on a screen. In the next 8 minutes, you'll understand how currency values are determined, why some currencies are strong and others weak, the role of central banks and inflation, how global trade and debt influence money, why currencies can crash, soar, or stagnate. This isn't just finance. This is economic reality. 1. The basics. What makes money valuable? Money itself isn't inherently valuable. A banknote is just paper. A coin is mostly metal. Even gold, while rare, only has the value we assign to it. The value of a currency comes from trust. Do people believe it will hold value tomorrow? Supply and demand. More money in circulation generally reduces value. Economic strength, GDP, exports, imports, employment, and innovation all matter. Government stability. Political chaos usually weakens a currency. Think of the US dollar. Globally, it's the dominant currency. Around 60% of international reserves are held in dollars. Why? Because people trust the United States to honor its debt, maintain inflation, and sustain a massive economy. Meanwhile, take the Venezuelan bolívar. In 2013, 1 US dollar equals 6.3 bolívars. By 2023, 1 US dollar equals over 25 million bolívars. Hyperinflation, political instability, and collapsing oil revenues decimated its value. A strong currency doesn't mean everyone in that country is rich. It just means the money retains purchasing power internationally. 2. Historical origins: gold, silver, and paper money. Why do some currencies seem more respected than others? To understand that, we need history. Gold standard. Pre-1971, most countries pegged their currency to gold. 1 US dollar equals 23.22 grains of gold. People trusted that their dollars could be converted to actual gold at a fixed rate. Silver and bimetallism. Some countries used silver alongside gold. This created fluctuations because silver supply could rise or fall faster than gold. Paper money. Once countries moved off precious metals, money's value depended on government promise and economic strength. When the US abandoned the gold standard in 1971, the dollar became floating money. Its value determined entirely by markets, trust, and policy. Other countries followed. Today, almost all major currencies float. 3. Exchange rates. How currencies compare. A currency's value is often expressed through exchange rates. Floating rates. Market forces decide. The euro, dollar, yen, and pound move based on global trade, interest rates, and speculation. Fixed rates. The government pegs its currency to another currency. For example, the Hong Kong dollar is pegged to the US dollar at roughly 7.8 Hong Kong dollars equals 1 US dollar. Managed floats. Some countries, like India, allow the rupee to float but intervene occasionally to prevent extreme volatility. Example, currency value versus USD US dollar. 1 euro 0.92 Japanese yen 140 Mexican peso 17 Swiss franc 0.90. Notice the difference. That's not random. It reflects economic health, inflation, and global demand. 4. Supply and demand. Inflation and printing money. One key factor is how much money exists. Printing too much money reduces value. Zimbabwe in the 2000s printed trillions of dollars. Result? Hyperinflation. At its peak, a loaf of bread cost 100 trillion Zimbabwean dollars. Printing too little can make money strong, but it may slow the economy. Japan has experienced this for decades, with ultra-low interest rates and minimal inflation. Central banks balance growth versus stability. Too much money equals inflation. Too little equals stagnation. 5. Interest rates, the central bank lever. Central banks don't just print money, they control interest rates. Higher interest rates attract foreign investors. They can earn more by holding that country's currency. Result? Currency strengthens. Lower interest rates encourage borrowing and spending domestically but weaken the currency globally. Example, in 2023, the US Federal Reserve raised interest rates to fight inflation. This made the dollar stronger compared to other currencies, including the euro and yen. Currency isn't just for buying goods. It's an investment. Traders constantly chase higher returns, moving billions of dollars daily. That movement changes currency values in real time. 6. Trade balances: exports, imports, and currency strength. Another factor is international trade. If a country exports more than it imports, foreigners must buy its currency to pay for goods. Currency strengthens. If imports exceed exports, more of the domestic currency leaves the country. Currency weakens. Example: China exports massive amounts of goods. To buy those goods, foreigners exchange dollars for yuan. This supports the yuan's value. The US imports more than it exports, creating a trade deficit which can weaken the dollar. But other factors like global trust keep it strong. Trade isn't just goods. Debt, investments, and services all influence currency strength. 7. Government debt and currency value. Countries borrow money by issuing bonds. The size of debt can influence currency strength. Moderate debt is normal. Investors see it as safe and lend money. Excessive debt can scare investors. They may sell that country's currency, causing devaluation. Example: US debt is over $33 trillion, but the dollar remains strong because it's the global reserve currency. Argentina has defaulted multiple times, causing the peso to lose value dramatically. One US dollar equals 200 Argentine pesos in 2023. A country can have massive debt and still maintain a strong currency if investors trust its stability. 8. Political stability. Confidence matters. A currency's value is also a measure of trust in governance. Wars, coups, or political chaos often lead to sharp devaluations. Countries with stable governments, transparent policies, and rule of law maintain stronger currencies. Example: Swiss franc is strong not because Switzerland is rich per capita alone, but because the country is politically stable and fiscally responsible. Venezuelan bolívar collapsed largely due to political mismanagement and economic miscalculations. Currency is psychological as much as economic. If people believe it will hold value, it does. If they doubt it, it crashes. 9. Speculation, currency trading, and volatility. Trillions of dollars are traded daily on the foreign exchange. Forex market. Traders bet on currency movements based on news, interest rates, elections, and global trends. Large trades can temporarily spike or drop a currency. Speculation can amplify underlying economic strengths or weaknesses. Example: in 2015, the Swiss National Bank removed its peg to the euro. The franc jumped 30% in a single day, causing chaos for exporters and traders worldwide. Money isn't just for spending. It's constantly being evaluated, bought, and sold by investors, adding another layer of value fluctuation. 10. Globalization. Why currencies affect everyone. Finally, currency value isn't local. In today's interconnected world, corporations hedge currencies to protect profits. Countries hold foreign reserves to stabilize their own currency. Currency wars happen when nations manipulate value to gain export advantages. Example: China has over $3 trillion in foreign reserves, mostly in dollars. This helps maintain the yuan's stability and global influence. Countries like Japan and Switzerland occasionally intervene in markets to prevent excessive currency appreciation or depreciation. Even if you never leave your country, exchange rates affect the price of imported goods, inflation, and investments. Conclusion: the real question. So why do currencies have different values? It's a mix of economic strength, government policy, inflation and interest rates, trade balances, debt levels, political stability, market speculation. A strong currency doesn't guarantee prosperity at home. Next time you check an exchange rate, remember, it's not just numbers, it's history, policy, psychology, and economics all rolled into one. Currency isn't magic, it's power, and understanding it changes how you see the world.